Experts predict massive property boom in prices followed by a big major crash in 2026. On this video, I'm going to break down what this means for you and your property investments. If you're brand new to the channel, I've been in property for over 3 years now. I started off with rent to rents and I reinvest that cash flow into assets that I own. I've got a team of 10 people that run my rent to rent portfolio. It's over 50 properties, which is around over 150 tenants at the moment. And I'm just super curious to see what's gonna happen. And I've got some interesting ideas as to how you can protect yourself from what is likely to be, a crash, because it's only natural that market cycles say there is gonna be a crash. Property market has been going mental throughout the whole of COVID with all the government support, and it will correct. So you need to protect yourself. So Fred Harrison actually conceived the idea of the 18-year market cycle, and he predicted the last 2 property crashes. And he says the next one is actually going to be in a few years' time, around 2026. So what does this mean to us as property investors? Well, first things first, should you be buying property now? And my opinion on this is if you're buying at a discount, then that's okay, as long as you're not too highly geared. Highly geared basically means if you're getting 5, 10%, 15% mortgages, you are naturally going to be at risk of negative equity if the property crashes. But as long as you're not too highly geared and you're buying at the right price, I still think that buying property is a good shout. But there are a couple of things you do need to watch out for. First one is negative equity. This means if you buy a property for 200 grand and it's worth 200 grand, and then the market drops in 2026 by say 20%, what that would mean is when you come to refinance, you might be in negative equity, which would mean that you would actually have to add money to your deposit in order to get a new mortgage. Now that is scary, and it's scary on one deal, but what about if you've got 10 deals or 20 deals? Like that is enough to actually bankrupt you and just completely ruin your whole property journey. Bang. A lot of people in 2008 never recovered, in fact. So that's the first thing. The second thing is interest rates, which means that naturally with inflation at around 5.4%, the highest in 30 years at the moment, interest rates will also increase. And when they do, that means your loan payments, okay, your mortgage payments are going to increase. So if you are going to buy a property, you need to make sure that you're building in enough cash flow to withstand those increase in interest rates. And to be honest with you, when you do get accepted for a mortgage, they will do what's called stress tests to ensure that the rental income can cover an increase in interest rates. But nonetheless, you just want to make sure that you're protecting yourself. That's one of the reasons why I love HMO and SA, because I know that the cash flow is so high that should interest rates spike, I don't need to worry about my cash flow, because if I'm making £1,500 or £2,000 a month, worst case scenario, it's probably going to go down by a few hundred, but it's not going to wipe me out. On the other hand, if you've got a standard vanilla buy to let and you're only making £200 a month, then naturally spikes in interest rates could really dent that, really dent that significantly. So I think there's key things here. The first one is you want to make sure that you're either buying at a discount or you're buying a doer-upper where you can add value to protect your equity. And then the second thing is you need to make sure that you're buying assets that have the ability to do big cash flow to protect you from any interest rate spikes. Inflation, let's cover it, man. Let's just talk about this for a second. And I did some content on Instagram about this not long ago. If you're not already following me, head over to Instagram at Simon Smith Online. So at the moment, with inflation rates being around 5%, that means that if you've got 100 grand in the bank right now, next year, okay, it would essentially be only worth 95 grand to you, okay? Because what happens is the price of living increases by 5%, which means you can buy 5% less for the same amount of money. So what this means is you kind of walk in this balance. You don't want cash. Like, I hear some people saying, you know what, I'm just stockpiling cash, ready for it. But in a way, when you've got inflation, you don't want a load of cash. You want to chuck it into a property. Because as you can imagine, if you've got a property, it's 250 grand today, and it's going, the rate of inflation is going up by 5% a year. In 3 years, that's going to be worth significantly more. You're not going to be able to afford the same house that you could now. Are you with me? So I guess a little point for me is I don't want a lot of cash. I want my money working for me because I know the buying power of my cash is going. So that's a bit of a summary of what we're doing in terms of buying houses. I guess there's one more tip here. When you get a mortgage, typically you're going to be in it on a fixed rate for 2 or 5 years usually. So we're in 2022 now, which means if you go for a 5-year right now, you're going to be refinancing in 2027, just after the crash. So that could be a bit risky. But then again, if the crash is in 2024, you might ride out that crash. If the crash does happen in 2026, in theory, you could do a 2-year fixed now, refinance in 2024 for 5 years, and then that would take you to 2029 to allow the prices to increase. So these are the kind of things you need to be thinking about. And to tell you the truth, I'm trying to hedge my bets a little bit. So I'm going to do some that are 5 years in case the crash happens in 2024. And I'm going to do some 2 years so that if the prices continue to go up, I can refinance and lock in for 5 years. Now, a lot of people, they look down on rent to rent. They're like, do you know what? You don't own the asset. It's not real property investing. But in uncertain times, rent to rent is golden. Why? Because we don't own the property, so we don't have a mortgage payment or interest rates to worry about, and we don't need to worry about the value of that property because we don't own it. So I'm doing a combination of two things. I'm massively gearing up and investing into my rent to rents because I know they're going to be the cash flow that will see me through what's going on over the next few years. And in terms of purchases, I'm taking my time. I'm only investing what I can afford. I'm not over gearing. I'm adding massive value. I'm refinancing, but I'm just taking my time with the purchases and not scaling too quickly. So I hope that's useful. Guys, whenever the market goes up, it is ultimately going to crash. I hope you found value in this video in terms of how you can prepare. Closing comments, buy property, just be careful. Just be a little bit careful, buy at a discount, make sure the cash flow is massive, and strategize as to the 2 and 5 years to see through the next crash. And rent to rent, go full steam ahead, control the assets, and make sure you've got enough cash flow to see you through the next crash. I'll see you in the next video.